Hello everyone, this is me Anmol. So for today's presentation, we have financial decision making. So quickly moving on to production part. The company is Summit Trails, which exports in luxury mountain expedition. The new offering is a luxury expedition package for high net worth individuals. So talking about the investment and financials, the investment, the initially invested amount is 200,000 euro, which has already been invested. And so the additional investment required for the project is about 5 million euros. Total market value of the project is estimated to be around 9 million euro, and the project lifespan is to 5 years. The financial viability is 7.14% of the ACC, which is 2.95 billion, is also considered to be a highly attractive investment. The history, looking about the historic performance, WACC is about 18%, which is around 7,000 euro. It's less attractive, but still positive. So about the company, it is a luxury travel company specializing in guided and personalized mountain exploration, renowned for crafting remarkable and luxurious travel experiences for adventure enthusiasts. Now, our mission and vision. So talking about our mission, it aims for a new benchmark in premium adventure tourism, make mountain adventure more accessible while maintaining luxury and exclusivity. Also promises to deliver an unforgettable and alluring experience to high net worth individual travelers. The projected cash flow, the total investment required is about 6.2 million euro, where 5 million is for helicopter acquisition, and 1 million is for working capital. 200,000 is invested for the initial business depreciation and financial consideration. Talking about, we got this project duration 5 years. This is also a depreciation. Service value is about 100,000 euro, and variable cost per client is 12,000 euro. And we can also the data from year 0 to year 5 in millions. So talking about WACC is a financial metric representing a company's average cost of capital from all sources, which is also a debt plus equity. Impact of WACC on investments. Lower WACC means less risk, lower cost, higher profit. Higher WACC means more risk, higher financial needs, lower profit. So WACC is investment decision. We need to compare WACC with expected project costs. Company valuation used to calculate net present value. This assessment, lower WACC is stability, higher WACC is riskier investment. So NPV and payback period, we got investment recovery timeline, which is in between 3 and 5 years. Key financial metrics, we got present value of cash flow, which is 8.99 million euro. Net present value is 2.94 million, which is highly attractive investment. So this means faster payback period, which promises lower risk and quicker return. Strong NPV, project generates significant value over time. Positive cash flow, financial viable, and worth investing. So the scenario 1, NPV and payback period. We got payback period between year 3 and 4. Present value of cash flow is 8.99 million. Net present value is 2.9 million. Scenario 2, where the WACC is 18%, payback period between 4 and 5 years. Present value of cash flow is 6.3 million, and net present value is 777,000 euro. Still positive, but less attractive. This means lower WACC, 7.14% in the value, faster payback, higher profitability, higher WACC 80%, slower payback, lower returns. This is an Lower WACC makes it much more attractive. As we can see the calculation below. Investment appraisal techniques. Net present value. So the difference between the present value of cash flow and present value of cash flow. If NPV is greater than, we need to assess the closing. So the good side is accounts for time value money, considers all the cash flow. So in IRR, discount rate at which NPV of is zero, IRR makes investment. If IRR is greater than WACC, we need to accept the project, and the positive side is useful for preparing projects. Investment appraisal techniques, discounted payback period, time taken to recover the initial investment while accounting for time value. Though precise than normal payback period, it still doesn't account for cash flow after payback period. The good side is more accurate than payback period. ARR, we got evaluates profitability using accounting profit as opposed to cash flows. If ARR is greater than required rate of return, accept the project. It's easy and simple calculation, good for comparing profitability between projects. Funding options, equity financing, raising funding by selling ownership shares. Options, angel investors, VC, IPO. The good side is access to network and expertise of investors, good for high risk, high growth in business. Debt finance, borrowing money to be paid with interest. The options are bank loan, bond, microfinance, loans. Pros, interest are tax deductible, ownership of the business remain. So the funding options are internal funding, short-term loans, condition for getting finances, status of business, track of expenses and earning, inventory, source of revenue, collateral compliances. So for the conclusion, so WACC of capital project WACC 7.14%. Indicates high NPV and faster payback period. So the historic WACC, which is 18%, it indicates lower net present value and longer payback period. So in conclusion, historic WACC may be relevant for this. Payback period comparison. Simple payback 2 years, 9 months. Discounted payback 7.14% WACC 3 years, 2 months, which indicates faster recovery. Discounted payback 80% WACC 4 years, 3 months, slower recovery. Net present value NPV analysis at 7.14% WACC to 9.5 million. Strong positive and high net at 18% WACC, 777,000 euro, still positive but less attractive. Investment takeaways: lower WACC 7.14%, higher NPV, faster payback, lower risk. Higher WACC 18%, lower NPV, slower payback, higher risk. So the decision lower WACC is and we got this indices for calculation, which justifies our presentation. Thank you.